we do say that
No
please.
sexual offense.
No. We notify people that there could be obscene language in our episodes. So
What
that's
the
okay.
fuck?
I will talk calmly, Ville, and then it will be over.
Hearing is believing, my friend.
Are you trying to suggest that I can never talk calmly?
Yes.
There we go.
Okay.
We don't do any edits, so even if we mess something up, we will leave it in in the actual published episode. It's part of the charm.
It's called the raw concept, no?
Yeah. No, we are an indie podcast, so no edit.
So where's your man bun, Ville?
Yeah, I think I can't grow anymore. I'm getting too old. All right. Good. So, ready to go.
We are.
We'll do the clap.
Welcome to Fintech Daydreaming, the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies. We bring you real-life examples from global and local thought leaders, as well as experts working within the financial industry, and seek out the best stories from the front lines of financial services innovation, where dreams of industry pioneers meet reality. Hosted by Krogdahl and Ville Sointu. This is Fintech Daydreaming.
Hello and welcome to another episode of Fintech Daydreaming. This is episode 2 of the season that we are on right now, and I cannot believe the first month of this year 2023 is already almost behind us. And by the time you're listening to this, it will be behind us, and we will be already in February. I cannot believe the speed of January and all the things that are going on at the moment. But that will not stop us from producing fintech content for our dear listeners. And this production will, of course, never happen without my dear friend and co-host, Paul Krogdahl. So, Paul, how are you today?
I'm good. I'm fantastic. I'm intrigued by how you manage to measure the time of months differently. I mean, as far as I was concerned, days were the same amount of hours, minutes, seconds, and that rolls into the next day. So if January moves faster for you than February, then that's interesting. I think we need to investigate that a little bit further.
Yeah, I think it might be related to the fact that I was traveling to US West Coast for the past couple of weeks. So I technically did just lose 10 hours of my life sitting on planes, and I'm also fairly jet lagged, so that those might be components in the equation.
Yeah, but you lost the worst 10 hours of January, so it was okay. I mean, whilst you were losing those hours, the rest of us were having a fantastically horrible time, so don't worry.
So you're suggesting that the Finnish winter in January is not the best time? Or...
It could be.
Okay, fair enough. But enough of that. I think we would like to go on to the topic of this podcast, which of course is fintech and all the interesting people working in this space, sharing their stories with us. And this episode is not going to be an exception. Today we're joined by Anders Olofsson, who is going to just now tell all about himself and why is he working in fintech. And as my friend Paul always likes to ask, what is your superpower?
My superpower, Ville, and thanks for introducing me. And I'm just trying to break into these male bonding that you guys are doing so I can get part of the gang. My superpower, that wasn't part of the pre-pack package that was provided. I think that on a serious note, I'd say curiosity. But I think that the other superpower is that I've done the marathon in 2 hours and 20 minutes.
Wow, that is a superpower.
You beat me. Which marathon?
It was a superpower that I'm a big liar. I can make a good bluff, Paul. I think that's my superpower. I can pull off a good bluff.
Mm-hmm.
Is that a good one?
Yeah, that's a good one. And Anders, tell us a little bit about yourself. I mean, what do you do?
Thanks, Ville. I'm currently based in what is now sunny Dubai, where I've been for about 3 years. I moved here to head up Visa's effort to break into real-time payments. I've had some, what now? It's getting close to 30 years of payments and banking technology experience. Worked for companies like IBM, Paul himself. I worked for what was then Logica, where I learned most of my stuff in payments with some excellent people. And I worked with a few organizations, and most lately I worked for Finastra, where I worked until last summer. And currently I'm actually helping fintechs, international fintechs, predominantly Europeans, to establish themselves as an advisor, as an investor, to set up their business in the Middle East and Northern Africa. So I get in contact with a lot of different fintechs, not only in payments, but across lending, core banking, and channels and wallets, and even into Web3 and what's blockchain, is it? So that's what I do at the moment. And I enjoy it quite a lot. I mean, not only the weather is dramatically better in Dubai than in Helsinki, but also the Middle East is an extremely vibrant community. And obviously there is a significant amount of investment going on with only not sovereignty funds, but others investing a huge amount of money in this region. So it's extremely exciting, and also to work with European fintechs. So that's what I do, Ville.
Yeah, wow. I mean, that was a long list of things that we love to talk about on the podcast, and with the added element of the Middle East fintech space, which we definitely need to touch during our conversation today. So yeah, looking really forward to it. And you forgot to say one thing, Anders. We have one thing in common. We always tend to be on stage in Stockholm during the Stockholm Fintech Week together. Last time we met, we were having a panel discussion about central bank digital currencies, and I think in a couple of weeks we will both be speaking in the Stockholm Fintech Festival as well. So looking forward to catching up once we
But I did make a request, Ville, that we would not be in the same panel. So I contacted the organizer and said, can you keep me at arm's length away from Ville, because he knows his shit and I'm full of BS. So I don't want anyone sitting next to me calling my BS out. So I did a special request. But yes, we will both be in the Stockholm Fintech Week.
You're not doing yourself an awful lot of good favors here. We've brought you on as a thought leader, someone who's going to share with the world the intricate details of the future of payments, and that's twice now. You've already said you're good at bullshitting, and even better at bullshitting.
I'm an overachiever, right? I always want to overachieve. So when you get your quota, you get your budget, you get your setting the expectation, you keep it low, and then you overperform.
Yeah.
Okay. So we're going to start with the future of payments is Bitcoin, right?
Oh no. Well, no, Paul, it is not the future of payments. And are we going to start with that now, or do you want to take it later on? Or do you want my take on Bitcoin?
I mean, we usually do a joke in the beginning, so this actually qualifies for a joke in my mind. But so why don't we start there? So let's go for it. What is Bitcoin the future of payments?
No, Bitcoin itself is not the future of payments. It's not the future of anything. I keep getting into this debate whether it's like online on, I don't do Twitter, but we are like a big WhatsApp group. And for the good thing with all these new people getting into the fintech industry, I mean, if I believe I do a lot of BS, there's so many people who do BS in this industry. And it seems that everybody becomes a thought leader and they have a point of view, whether that is Bitcoin going to go to 60K. And I typically have a methodology in life that I always ask 5 whys. If someone is stating something, I always go why 5 times, because then you get the root cause or the root argumentation of what people mean. But when you talk about Bitcoin, you can do 2 whys and then people are empty. I mean, it seems that there are so many people that do not even know the difference between commercial money and central bank money. People don't understand the role of the sovereignty of a central bank. They don't understand what actually a monetary policy of a government is and what that means for the sovereignty to the stability. And if you don't have those foundations, which is you don't need to do economics as a major university, but if you don't even understand those fundamentals, I think that I cannot see that people can have any valid argument for stablecoin, crypto, any kind of crypto, if you don't understand that basis. And I think that my number one reason why Bitcoin would not sustain is that it's a threat for countries' sovereignty over their monetary policy. So assuming going back to Lehman, and I think that we touched upon it briefly a year ago, Ville, but assuming that Fed could not run their own currency and intervene on the monetary market during Lehman, a private organization would not seek the interest of stability of a country. And I think that we probably would all be queuing up for getting free soup. Would Bitcoin be the prevailing currency back then? And there's also, I understand, all the getting rid of fraction, cost, and the real-timeness and 24/7 of a crypto. But the problem is, well, that yes, it's another asset class, but it's an asset class that doesn't fulfill any purpose whatsoever. So I don't see rather why Bitcoin, and I haven't heard yet a good argument. I'm a great believer, and probably going to debate it, on stablecoin, and I'm a great believer in commercial money. And to me, a bank issued stablecoin is equal to today's commercial money. So on that, I'm a great believer, because I'm a great believer in blockchain and the capabilities of blockchain, and the efficiencies it bring, the programmability, and all the exciting things that a blockchain-based currency can do. But on Bitcoin, Ethereum, or World Cup coin, or Dogecoin, I do not believe. Do you agree, Ville? Challenge me.
Let's get back to the stablecoin and blockchain discussion. But we've already talked about that many times, so if our listeners might know what's coming. But you did raise a couple of interesting points, which I do want to circle back to a little bit, which is that there's a lot of these quote-unquote thought leaders in this space who don't really understand the differences between different types of money. What is central bank money, what is commercial bank money, and what is private money. And to a certain extent, that is a problem, of course, for thought leaders, of course. But at the same time, I don't think the usual people just dealing with day-to-day transactions should even know the difference, because that's, interestingly enough, one of the questions that many of the central banks are now asking themselves, is that if we provide, let's say, a central bank digital currency, it still needs to be denominated in the currency that is already being used in the countries where they are operating. So what is the difference between a digital central bank euro and a digital commercial bank euro when they are in regulated applications? This is not clear from a consumer standpoint. If the only difference is that the app is branded to be a central bank application instead of your own retail bank application, what's the reason for using it? And I don't think that there are really good answers to this specific question. Or, I mean, Anders, what's your view on this kind of? Should it make a difference?
I agree with you. Technically, we both know there is a difference.
Yeah.
I think that as well, that today the commercial money today are electronic money, right? Agreeingly, similar to an RTGS account where banks are holding their central bank money, they're all electronic. And in all fairness, there is a difference, because assume you have a deposit of €1 million in your Finnish bank, Ville, and that bank goes bankrupt. Then obviously you will not get your €1 million back, right? And there's a different, whether you would be able to have money with the ECB in euros, deposits at the ECB, that the likelihood of ECB going down is way much smaller than your Finnish bank. So obviously there's an element of difference in risk of holding central bank money digital, and as well whether that would be electronic or digital. There is a difference, and based on that, there is actually a different risk. There should actually not be a one-to-one exchange rate. And going back to Sweden back in 1880, we actually had two different currencies. We had two different physical bills. We had central bank bills and we had banking bills. And the exchange rate was not one. So we have a dual economy or a dual currency, but they're all called the krona. But they did not necessarily have a one-to-one because they were coming with a different sense of risk. But assuming that you are banking with a stable organization, you have your digital currency, then I agree if it's all fulfilling with regulation. The question then is, could any private institution then issue a stable coin, and would we be as reliant upon that private institution, whether that would be an FTX issuing it or even you would have some other institution doing it versus a bank versus a central bank? Personally, I would prefer, all other things equal, to hold CBDCs than holding a stable coin with a bank. But then again, my interest rate, well, if I get an interest rate, presumably would be different. And then you can also argue, are you going to get interest rate on your deposits on a stable coin? Because some people are make an equal sign between a digital currency to cash, and you don't get interest on cash. So I still haven't seen any good insights on how you actually incur interest on deposits if it's considered to be cash. But I think that there should not be a one-to-one exchange rate because the risk is different. Or do you think, Ville, do you think that there is technically there is a difference, right?
Technically, of course, there is a difference, and the liability is really the big difference. So if it's the liability of the central bank, then that's at least, you would assume that it's quote unquote safer. But then at the same time, they're being implementing these limits, for example. So you cannot hold, an individual cannot hold over a certain amount, which is typically lower than the deposit guarantee provided by the government for retail bank accounts. So I think that, again, it's a very nuanced discussion. But actually, before we move on to other interesting fintech topics and the debate on the stablecoin, Paul, what's your view on this denomination topic?
I'm just enjoying you two having a debate over this. There's a couple of small things that go through my mind listening to Anders. I start thinking about the difference between, whether we're talking about fractional banking or not. With stable coins, you tend to have the assumption that it's fully backed, so it's not fractional, it's full reserve. If you're talking about central bank digital currency at the same time, you're assuming that that's full reserve, it's not fractional from a banking perspective. If a central bank digital currency is issued to the citizens directly from the central bank, then I'm assuming that's having a different risk rating than if it's actually mediated through a bank, a private organization, like you said, Anders. So I think there are sort of partial dynamics in this that change some of the underlying assumptions and possibly the risk levels as well, right?
So, go ahead, Paul.
No, go on, Ville.
Also talking about risk, talking about regulation, and I think this leads us nicely into the discussion about stablecoins, because if we kind of put commercial bank money in the middle, then the safer version of that is the central bank digital currency, which is a central bank liability, the digital equivalent of cash, so forth and so forth. Then the stablecoins are like the private money of the digital world in a way. Now, we all know the problems with stablecoins that we have seen in the market. FTX, we know that there are some transparency questions with regards to the largest stablecoins like USDT. And then there are some that seems to be at least somewhat more trusted with the market, like USDC, for instance. Not promoting any of them and not putting any of them down, just pointing out that there are different perceived risk levels for different kinds of private stablecoins. How is a regular user with the kind of, let's make the assumption that stablecoins would become accessible, truly accessible by larger publics or larger crowds. And then how does a normal person that's on a day-to-day basis dealing with their own day-to-day issues supposed to know what is the risk level of a stablecoin versus central bank digital currency versus, say, a retail bank account balance? How are they supposed to know the difference, and how should we fix the problems that we have today in the stablecoin world? What's your view, Anders?
But then again, Ville, isn't that the same? If you assume you move to Spain and you want to put deposits into a bank, you can choose to go to a bank on a brand that you recognize, or you can choose actually to deposit with someone that looks fancy and glossy and you think that that seems to be a cool bank. How can you really, as a normal user or a bank client, have any capabilities to assess, you know, the stability of that organization? It's going to be very, very, very difficult. And I think that that's going to be the same. And I think that you started off this question by talking about regulation. And I think that that's going to be the key, that if you have a unified regulation across whatever region, ideally global, but I don't think necessarily that's going to happen, but at least across Europe, US is going to come up with a regulation that stipulates what kind of liabilities you can have, what kind of security you need to do, and what kind of levels of liquidity and what measures you need to take. I think that at least provides a level playing field for those issuing a stable coin. But I think that eventually it's going to come down to the same kind of assessment as a customer as you do with your retail bank today.
I disagree.
I don't necessarily see a big difference.
I disagree because like you said, if I go to Spain and I take with me a suitcase full of euros, it doesn't matter which bank I go to. I'm only depositing euros and it's still going to retain as euros, even though it goes from being public money to private money. It's being deposited into account. It's still euros. But when we start talking about stable coins, you can have stable coin XYZ 325 and whatever else you want. How do I know which of those stable coins are actually more stable, more reliable, less risk for me than any others? So actually, there's a big difference between evaluating a institution to look after my euros, which remain as euros, or whether I'm going to convert my euros to stable coins with Joe Bloggs around the corner who happens to have 2 petrol stations.
But we're talking about the bank guarantee, right? How much money you traveling and receiving.
Wow, that's the first one. We lost the guest.
Was my disagreement with him too harsh?
Yeah. It was like, oh, this is too much of a disagreement for my taste, so I'm gone.
But there we go. I mean, these things happen sometime, and he's back.
He's back. Wow.
Yeah, no. I had to
That's
do
his
pirate.
superpower.
Well, actually, I had to call a friend to check out what the fuck I can answer you. So I thought that, all right, break it. Now he's doing the tough questions.
So now you've used the call a friend card. You can't use that one again.
Yeah, I know, but it's going to come. So, but then again, you get the bank guarantee. You deposit 2 million euros. You take your last yearly bonus, Paul, and you go and deposit that in a stable coin. Of course, you may not be insured that if that currency or that organization defaults, that you're going to get the money back, similar to your retail bank. There's just a certain level that you are granted by the guarantee. And if an organization, whether that is a bank or it's a coin, if it defaults, it's never going to hold the full set of assets to correspond. It's always going to be over leveraged, and that's going to be the problem, because also the liabilities on the underlying bonds may depreciate in value. So that's always going to be the risk. That how do you ensure that you have? Because I cannot see that you need to be fully backed on a currency, because commercial money today is not. Ville?
There's a reason why we have regulation, right? So when it's not fully backed, so we're running a fractional system. You're running the fractional system according to the rules and regulations and laws that define the fractional system. The problem I might have maybe with these private solutions is that there's less transparency and less clear understanding on what actually are the rules, if any, that they are using to define how they go quote unquote fractional. I think we saw what it can look like in the worst possible case when FTX blew up. We could of course argue that that's the way most of the exchanges are working even today, but again, let's not go there. In my mind, the key difference there is that you're able to go and audit a bank, and they will comply with the rules and regulations that define how the system should work. And if they don't, they will be put out of business. As simple as that. So that's the key difference.
And on top of that, part of your money that is actually deposited into a licensed, regulated bank is actually protected, right? Even if the bank does default and go under, certain amount of the money has to be returned to the customers. Now, I know it's not the full amount. Like you said, if I take my bonus from last year being 10 million euros and put that into a bank account and the bank defaults, I'm not going to get the 10 million euros back, but I am going to get a percentage of that. Whereas
but it's going to be
stable
small,
coin
right?
owned
So there's
by Diggly Dongly Man is not going to give me anything. We've seen that.
Yeah, but it's going to be fractions. I think that we can agree that there is a difference between a stable coin, a private stable coin, and CBDC. I think that you also made another point, and to this, I'm not really sure how that's going to play out, but I'm keen to get your guys' view as well. That you made another point as well. You touched upon interoperability, Paul, where you said that, how do I know that? Let's take JP Morgan's Onyx as an example, right? JP Morgan is now bringing other banks onto Onyx, and they're going to be basing it on a basically JPMC coin, which they are backing. The question is that, can I use that money to go and buy something and exchange it for someone who is not using JPMC coin, or do they need to have some kind of correspondent relationship so I can have this constant interoperability with all these pools of CBDC? I mean, obviously now SWIFT is trying to come up with a solution to ensure that we have the cross-border capabilities using interaction or interoperabilities with different CBDCs. But if we have all these different coins in stable coins, all euros, we got 20 different issued euro stable coins. Will we need to go through an exchange to move from a JPMC to Onyx to a Nordea coin? Is that going to be done by an exchange that needs to be a middleman to exchange between the two, even though it's an exchange rate of 1-to-1, which then going to come with the transaction cost, so it's not going to be super efficient. So that is as well another question, that how do you ensure that interoperability between different blockchains?
And then my next question is, who actually wants all this complexity, right? How many of, let's be honest, we're sitting here as geeks, fascinated by this topic. We love the whole banking industry. We love fintech. We love payments and, the stable coins. Let's go and play this one against that one and everything else. But 90% of Mr. Average or Mrs. Average, or these days it could be it average on the street, do they really want the complexity of 28 different stable coins, 16 cryptocurrencies, and their everyday cash split between central bank digital currency and this app and that app? And Christ almighty, they just want to go and buy milk and bread.
Yeah, so first and foremost, I think that I'm not going to try to change topics, but in general, I mean, I would be happy to change topics, but when I started with the payments, we had SEPA coming ahead. And I remember that everybody said that, well, once we are through SEPA and we got a bit unified payment industry in Europe, everything going to be calm. We're going to go back to basic. And also a part that everybody talked about, the loss of transaction revenue across banks. But then you look 20 years along the line and you look at even in B2B or B2C or even P2P, the optionality has just tripled, quadrupled, exponentially increased, not only for the end users, but as well for the banks. The way that the bank today can choose to send on behalf of the customers, send money. they have so many options. They can go through Visa, MasterCard, they can go through TransferWise, they can partner with TransferWise, they can partner with Swift, they can have the normal correspondent banking. There are so many options, all having their own treats and all their own benefits. But there are so many options. Whilst we thought 20 years ago, they just harmonizing the payment industry, you're going to make a standard, and it's going to be one way of doing things. We're going to lower the operating cost, and it's going to be super easy. So I think that in general, we have created, or the market has created, the optionality is just bringing actually too many choices. And I think that we are not getting to the core of lowering transaction cost, and ensuring that we meet all the important things with these real time and 24/7, and that it's cheap. We don't really need that many options. I mean, today you go as well going to purchase something, even H&M or Zara are going to have their own damn purchasing and payment capability. Do you want to have all these options? So I think that is as well a highly relevant question when it gets into stablecoin. Apparently, people would like to have different currencies, cryptocurrencies, because people invest in Ethereum and World Cup coins and what we talked about. So apparently people want it, but the question is that do they want it to use it, or because they like the thrill of gaming and betting on whatever going to take off? Yeah. So I don't see this improved or increased optionality as a great benefit, and nor do I think that having too many stable coins is providing any benefit. I mean, ideally we have one way of transacting, and that's a standard that is used by everybody, that is providing the same risk, that has the same level of transparency. That will also make it less of a burden for regulators, not having all these systems to look for. I mean, there's an obvious reason as well why central banks are, I'd say, 3 years behind when it comes to trying to regulate, because this is going super fast. The development in the market is just in such a speed. I mean, as an example, there's one country that actually do not accept crypto. They don't accept digital currencies. They don't accept real-time payments. They don't even accept cash. Do you know what that country is?
No.
Czech Republic.
Okay.
Czech Republic.
How is that?
That was my joke.
Okay, yeah. I just got it, by the way. Thank you. Yeah, I was just about talking about, but aren't they part of the SEPA? Oh, okay, fine.
They're not part of this. They're not part of the euro, but they run business in SEPA. They need to do it, but they have their own difficult standards. But that was my joke. I know that was mandated by the host who provided joke. I had another joke as well later on, but that was the daddy joke that I had.
We do want to hear the daddy joke towards the end. We did the Bitcoin joke in the beginning, so there's going to be a very joke-heavy episode. It seems like, which that's. I mean, apparently our listeners don't mind the humor in it, so it's all for good cause. But again, we could go on forever about the digital currencies, stablecoins, and blockchain for sure. And I think this debate is far from over. I'll see you in Stockholm. But we want to give you the opportunity to talk about a little bit other topics as well that you kind of kindly listed there in the beginning. So let me try to bring back the discussion a little bit to those things. So what do you think are going to be, now that we are looking at we're in February 2023 already, but what do you think are going to be the most interesting things that you will be following during 2023 in fintech space?
I think that there are many segments. I'm super keen to see how valuations of fintech is going to go. So that is one part, and I think that we're all very excited to understand how deep down our valuation is going to go and how are things going to change. And that's going to be partly driven by inflation and interest rates, and the macro factors, how valuations is moving. But I'm super keen to see in 23 the banking community, the old banks, responds to the fintech, what kind of strategy they will embark on. Will they, as they do now, continue to partner with fintechs? Will they increasingly acquire fintechs, or will they go head to head to compete with the same? I mean, taking a bit on, as an example, taking the learning from Middle East when it goes to buy now, pay later. I mean, there is about 4 fintech providers providing buy now, pay later solution in this market. And I think that most of Europe, you are maybe have one. And increasingly, you also get banks coming in doing transaction financing. So for instance, when I go and do a purchase with my credit card, typically at 9 p.m. at night, I get an SMS saying that, by the way, you went to the restaurant and you spent the equivalent of 100 euros. Do you want to do an installment on that? And so there's the financing arm is now being driven a lot by consumer financing, but also SME financing is where banks are finding innovative ways to improve their financing or coming up with solutions, taking head-to-head competition with the fintechs. And that's where I think that banks have spent the last few years in meeting up with the regulation, and in the payment space, they are complying with ISO 20022 that is coming up. And I think that at some point, banks needs to start getting the return on their investments. And I think that 2023, to me, is where I would be looking to see banks making that investment. And I think that to constantly partner with fintechs is a bit coward. Acquiring fintechs, to me, is a bit stupid. And I think that if you're a progressive bank today, you're really going to go head to head to compete with these fintechs, because you have the cash flow to fund those investments into new market and do the investment in customer acquisition. You have the capex to do any major investment. And in all honesty, I know that you left the banking industry, Ville, but bankers are not stupid. I mean, and well paid. They're actually pretty smart. And I think that there's a lot of knowledge in banks and in the people of the banks, that they are having really good ideas. So I think that that's what I'm looking to see, that how that would play out, and what kind of strategic direction banks will take into these new innovative areas. That's something I clearly going to look for in 23. And that will have a material impact as well on the valuation of these fintechs, what direction banks will take, because banks are going to make a shitload of money, at least for the next 2 quarters, given the interest rate, which is going to give them a head start to break into new customer solutions.
Yeah. So first of all, you can leave a bank, but you can never leave banking, in my mind. So I think fintech and banking will always be a part of my career and my life, in one way or the other. But I did want to make a few follow-up questions on what you said there. So I think the conversation around what is the relationship between traditional banks and fintech is an interesting one. Actually, something that we have discussed many times with other guests as well on the podcast, on how to do that in a good way, and what are the things you should think about, and what should you avoid in doing those things. But I mean, reflecting on a little bit what you said, do you think that there's been a change in something over the past year or two? Because we read headlines like with the current economic situation, that the venture capital is no longer as abundant as it was before for these fintechs, and then making the environment maybe in terms of growth a little bit more challenging for fintechs. Do you think this is going to change the way they interact with banks, or potentially partner with banks, or indeed does it change the way banks what is their attitude towards fintechs?
I mean, the first comment on, if you look at VC or PE, I mean, historically, they've been extremely having a big leverage on their acquisitions, and the valuations of fintechs has been basically financed through the bond market. And now the bond market is basically disappearing. That means that there is no availability of liquidity in the market to acquire these fintechs and hence to drive valuation. So that is the first point. And I think that also I could clearly see a big distinctions between fintechs who've been receiving funding that give them a 24 to 36 month runway, and how aggressive they are, and how I haven't seen anyone that got significant Series D or even Series C funding last year that is now doing layoffs. So those who has 24 to 36 month runway with liquidity, they are aggressively trying to take market share, whilst those who were planning to raise capital in 23, they are laying off, because now investors are increasingly looking for a net positive cash flow. And we all know that very few of these fintechs have barely any revenue. And it's not about, like 18 months ago or 12 months ago, we looked at projection. We extrapolated what we thought going to happen, and you see the revenue potential. We're going to take 1% market share, then we're going to grow, and that was how valuation was done. And with zero interest rate, you do net present value, evaluations go super high. Now there is an extreme focus on fintechs when it comes to valuation on generating cash, and that is obviously because of financing, but it's also that a demonstration of a business model and a solution that holds on the market. So I think that seed funding may not dramatically change, because that's not a huge investment and that's going to hold. But I see on the bigger rounds of funding that there is a clear look for cash flow and where you need to demonstrate. And I think that we have a few Scandinavian fintechs that been taking a bit of a hit when it comes to valuation, where there is just not enough cash flow. So I think that those fundamental financing thing unfortunately drive things more than innovation and whether there is an excellent use case in the market. So did that answer your question, Ville, or was that a bit going the wrong direction?
Yeah, I think we can talk more about the banks' attitudes towards fintechs now that let's just take the assumption that the business models of fintechs are changing, like you said. So they might be less growth oriented now due to the circumstances, and they might be more focused on becoming profitable. So the banks might see that, okay, so they stopped growing now, and this might give them a chance to have a different kind of strategy when it comes to fintechs altogether. Do you see that changing somehow, the attitude from banks?
So there's also an element how the business model of fintechs are changing. I think that if you go back 2 to 3 years, a lot of fintechs were approaching directly going to end users. So they were trying to set up a B2C solution and attract retail customers. Because we typically talk mostly about retail banking, because corporate banking is no 25-year-old understands trade finance or cash management or cash pooling. So that's a totally neglected area and probably a different episode. But so commonly we speak about retail banking, and there was a lot of providers and fintechs trying to acquire the consumers, the retail customers, and they are now pivoting, and they have done so to become a tech provider and almost doing enterprise sales into banks. And I think that has also made it easier for banks. And all right, we're going to buy a software service from you, and we're going to be a customer of you, and we're going to spend €1 million a year instead of acquiring you at 100 million euros or trying to do an investment equal 10 million euros and compete with you. So that is, I mean, I'm seeing it as my previous employer where I worked for enterprise sales companies, where my outlook for the big technology vendors like FIS, Temenos, Fiserv, that they are the one that are going to suffer the most, because these innovative fintechs are now taking piecemeal, not necessarily from banks, but they are taking business away from, with niche solutions as a niche player, from these established vendors, and offering capabilities, whether it's an implemented or a hosted or a SaaS solution. So they are then providing solutions to bank, who are then labeling it in a bank branded way and going to the market. So I see that's where I see the collaboration is, that fintechs are becoming vendors rather than partners and rather than competitors.
Yeah.
So that's my 22 cents.
You're sort of talking though about the outcomes and the effects of the growth of embedded finance, banking as a service, and the sort of general platformification of the banking industry, right? Where it's more about what are the complementers that you can integrate into your capabilities to enrich the experience for the customers, be that either retail or corporate customers. And it is that shift.
Yeah. True. I mean, there's also traditional ways that fintechs are providing technology. I mean, we have a few API aggregators who tried in the past to provide apps to end customers to do account aggregation, realizing that there was no money in it, and turned around and tried to become a technology providers, helping banks to do the aggregation, right? Being one example. You're laughing.
Yeah, I'm laughing because do you remember that one time we were both in Stockholm at a bank event, and I was on a panel discussion where I vocally stated that there is no money to be gained in account aggregation as part of open banking, and everybody told me that I was being an idiot.
I did not tell you an idiot. I did not say.
No, you did not. Lots of other people did.
Yeah, and they go like, yeah, it's like, yeah. So what's in it? I mean, that to me that was a good example. I mean, I think that it was a super cool technology, but they did pivot. These providers pivoted away from trying to acquire end customer, which is super expensive to do, acquire customers and to come up with a value proposition, unless you want to become a digital bank. And I don't think that the intent of these vendors were to become a digital bank. So, but leaning into the embedded banking and banking as a service, that is also another area that kind of gives me, what the F, right? So we're talking about banking as a service, right? So how long have we been doing banking service? To me, banking as a service has been around for so long. I mean, doing co-branded cards, which is, to me, banking as a service, because that's in a capability where you basically white label, you outsource your capabilities or you acquire capabilities from a provider. Super simple. I mean, we've been having that for ages, right? It's like a mobile virtual network operator, MVNO in telco. It's been along for very long. I think that it become more sexy and we got more technology providers doing it. And I remember as well having conversation with the now so much alive Wirecard, who had that capabilities many years ago, where they were providing banking as a service, but it wasn't that sexy at the time. But so I think that banking as a service has tuned up for banks predominantly to get scale on their investment that they have done. And I'm not sure really that have a sustainable business model, because I don't think it's going to be super profitable. And doing, white label cards was not super profitable because it also came with liabilities and increased OPEX. And given that a bank runs a 50% profit margin generally on their business, it may not be super attractive. So I think that to me, banking as a service is old banking. Nothing is new. So that is one.
So yeah. Today we started the discussion from Bitcoin and we ended in Wirecard. So I somehow feel like we've come full circle in the discussion from Bitcoin to Wirecard. And even though we always say in the podcast that the time really flies when you're having fun, this has been really fast this time. So it's not only January that is fast. It seems to be discussions with you, Anders, are really making the time fly. Because we're out of time. We think we need to start wrapping up the discussion so that we don't end up doing a 2-hour episode, which won't be enjoyed by many, I suppose. But we did promise the listeners your joke. So I think we are ready now for your promised daddy joke, and then we can start wrapping up.
The Czech Republic thing was a daddy joke. That means the joke there is that's a response you get on a daddy joke. The other jokes are for those listeners who may want to have a huge disclaimer on everything that they say. They can now tune out, and I do my joke. It's like a 20. Yeah, exactly for you, Ville. It's a 20-year-old joke. That was this guy that moved into a new city, and the first thing you do if you move into a new city, this was in the UK, you go to the local bar. So he went into the bar. And when he came in, he sat down in the bar and ordered his beer, and then looked to his left, and there was this guy sitting looking super depressed. And that was not the amazing thing, because in front of him on the bar was this small guy sitting down and playing the piano. Right, so exactly, Ville. I don't know if you're visible, but you lifted your eyebrow. It was like super weird. So he looked at it, but he looked so depressed. He didn't want to disturb him or anything. So he paid and left. And next day he came back, and the same guy was sitting there, and the same small man was sitting there playing the piano. And but no one seems to take notice at all. So he was like super confused, and this repeated itself a few days, and eventually he decided that I got to ask this man. So you know what, this is not super normal. Sitting in a bar is super normal, but having this small guy playing the piano is not super normal. So, dude, you got to tell me. So he said, yeah, it's a depressing story. So, because, I started renovating my house a few years back, and then I was tearing down the walls. And when I did that, there was a bottle in the wall. It was all dusty. So I took up the bottle and I kind of squeezed it, because it was all dirty and dusty from I don't know how many years, because the house was from the 16th century, this old English building. And so I cleaned it up and squeezed it a bit. And you know what? All of a sudden, the genie appeared. And I was baffled. And I said, the genie, so where did you, what's this? Are you the genie? The genie looked at him and said, sorry, my hearing is a bit bad. You need to speak up. So he repeated himself and yelled that, so what is this? Are you the genie? Am I going to get wishes? And he said, yeah, I'm old. I haven't been out for like 3,000 years. But yeah, you got to get, but you only get one wish, because I'm a pretty conservative genie, and you need to speak up, because I'm really don't hear that well. So so the guy listening to him said, all right, this is amazing. So what did you wish? Well, the thing is, I had it kind of a weird wish. I felt a bit embarrassed asking what I wanted, but eventually I told him. And the guy that went, so what did you want? I mean, you were wishing or you were whispering. I said, take a guess, man. Look at this 10-inch pianist.
Oh God! Oh yeah. Okay.
I think there is a delay. I think on my joke, I think that there is a delay from Middle East to Finland. I think that there is something technical, a glitch, making a bit of a delay.
Ville was just trying to find the connection back to Bitcoin, and
there is none.
Fair enough. Okay.
Oh, fantastic. Thank you.
Thank you so much for that joke and everything we've been discussing. Now, for the listeners that did not get enough of these bad jokes and the discussion about all the fintech topics, you can not only see us in Stockholm in a couple of weeks, but Anders, how can our listeners get to be in touch with you and have more discussions about fintech and everything else?
People are going to stalk me, and they're going to see my name, and they contact me through LinkedIn like everybody else. And and also keep in mind that I'm a gold member on LinkedIn. So everybody that goes to my profile are going to see that you've been visiting my site. So you can as well connect and push me a question.
All right. Thank you, Anders, and I will definitely see you soon as well. But dear listeners, thank you for hanging out with us until the end. As always, please like, subscribe, leave a review. It all helps us to find more listeners, and of course helps us keep this podcast running as well in the future. Again, we are doing this on our free time. We have no sponsors, so this is free content for all of you. All we need are those likes and reviews, so it's truly appreciated. With that being said, this has been another episode of Fintech Goodness, and we will see you in a couple of weeks. This has been Fintech Daydreaming.
This is Fintech Daydreaming.